any event, the basis is measured not by the current, the step up is measured not by the current basis, but rather by the amount of deferred gain. And so you seem to say, hey, if we can get the 10-year benefit by holding until 2047, even if we don't get deferral, why not do this? And I think that there were two suggestions that you made, one of which may have more problem with the statute than the other.
Okay.
The idea that one could start the 7-year period or the 5-year period after 12/31/26 would have a problem because you get the benefit of that step up only if the investment in the crop is associated with a deferral election, and the deferral election couldn't be made that way. So the other one, where you're saying, if I had a good deferral election earlier, maybe I should be able to continue to get my 5 or 10% or 5% step up subsequent to 12/31/26, as long as I started out okay. That one might have less trouble with the step up.
So actually, I wasn't necessarily tying the step up to the basis for the 10% and 15% cumulative based on getting the deferral or not. All I was pointing out there was that also in the statute, in terms of the deferral, the 10-year deferral, that is actually statutorily defined to be December 31st, 2026, to be paid April 15th, 2027, whatever that tax rate is at that point in time. But unlike the sections that deal with the 10% and then the extra 5% in the step up of basis, Congress did not put into the statute a time period. And because the proposed regulations were allowing up to the year 2047 for the Qualified Opportunity Fund to actually sell the property, and I assume that was done partly so that it wouldn't be a fire sale because there's a bad market after you've been holding it for 10 or more years. So too, it would not be beyond your ability, because you're not constrained by the statute. It could be in your regulations to also allow that sort of flexibility with the step up in gain of 10% and 5%. Because everywhere I go, at least when I listen to panels on I'm going to talk about the 7-year step up. In order to hit that, it's always talked about, well, that would mean that the investment has to be done before December 31st of this year. By December 31st of this year. And all I'm suggesting is, in your regulations, if you were to allow the same flexibility that you are for the sale of the Qualified Opportunity Fund to sell the property all the way to year 2047, if you allow that same flexibility, then it would actually enhance, I think, the ability of qualified opportunity funds to go into qualified opportunity zones, because they're not losing that 7%, they're not losing that 15% step up in basis over a period of 7 years.
I understand that point that you're making. You seem to be making an additional point, which was that you would be able to get the 5% and 7% even for investments into a crop subsequent to, I guess, the latest possible date would be the sale. You'd be able to, you can get to defer something that was sold in December 31st, 2026. Maybe you could make your investment as late as June of 2027. But beyond then,
right,
you would not have a valid deferral election, and therefore the 5% and the 10% step-ups would be unavailable for investments that good.
Well, correct, and also the zones themselves will automatically expire.
Well, but we indicated that maybe even that since we didn't want to have a situation where virtually all, where we didn't want to have a situation where virtually all of the 10-year basis benefits would be gone once the zones expired.
And we also didn't want to have a situation where we preserve the ability to get the step up, but once the zones expired, there were no continued requirements of complying with the economic focus in the zone. We soft pedaled the consequences of that exploration.
Yeah, and I think that's a good thing. Thank you.
Thank you, Brent.
Thanks.
All right, our next speaker is Jill Holman from Javelin 19 Investments LLC.
Good afternoon. Good afternoon, everybody. All right, let's lunch again. My name is Jill Homan, and I'm president of Javelin 19 Investments, a Washington, D.C. based development and advisory firm. I have 15 years of experience in real estate acquisitions and development, and to date, my firm has been involved with almost $200 million in qualified opportunity zone investments. I also serve on the board of directors of the Opportunity Zone Focused Trade Association, the Opportunity Zone Association of America. And since I last spoke to you on Valentine's Day, we have capitalized our Opportunity Zone student housing project in Baltimore, Maryland, and are poised to start construction. The project features what the OZ legislation envisioned in fulfilling a need, housing for students in ways that positively impact the community. While you have my working group submission, in the interest of time, I will focus my remarks briefly on 5 quick subjects, most likely to unlock still hesitant investors. I appreciate the chance to speak with you. The first topic is qualification of already owned property. So many properties owned by taxpayers as of December 31st, 2017 are the subject of planned development extending into 2018 and beyond. Still unclear is whether a sale of that property is needed in order for work done with respect to such property to qualify as qualified opportunity zone business property. Said differently, if a taxpayer has owned land or land and building prior to January 1st, 2018, can improvements to that land or land and building in 2018 or later qualify as QOZBP? The question is whether improvements funded by a QOF investment contribute a separate item of qualified property in situations where expenditures exceed 70% of the sum of the investor's basis in the already owned property and otherwise qualifying costs. The regulations could treat the pre-existing property as one asset owned by the QOF and its subsidiary entity and the improvements as another, and analyze the substantially all tests with respect to these 2 assets. I could offer mathematically confirming examples, but I think you understand the points. Other tax credits incentives specifically provide for the special asset treatment, and I wholeheartedly support this interpretation. The second topic is aggregating expenditures to satisfy the substantial improvement test. Under the proposed regulations, the substantial improvement test for used property is calculated on an asset-by-asset basis, eschewing the aggregation of related assets methodology. The statutory language which calls for expenditures with respect to the used property seems to more logically support an aggregating of eligible expenditures. Consider a single owner who owns multiple residential buildings and land on the same parcel in the same opportunity zone, and who has a comprehensive community-focused development plan to rehabilitate the buildings while adding a new playground for the younger residents and a new commercial area to satisfy the retail needs. These additions are clearly with respect to the existing buildings, but the current regulations would require that the rehabilitation meet the substantial improvement requirement on an individual basis. I recommend that the IRS adopt a regulation permitting the substantial improvement test to be passed with 3 things. 1, if a written development plan which meets the substantial improvement test on an aggregate basis, including both the rehabilitation of the used buildings and the cost of new construction. 2, expenditures are made on contiguous properties. And 3, the written plan is approved by a local governmental body responsible for authorizing development activities. The third topic is alternative methods of gain exclusion, and we've touched on this a bit before with the other speakers. Currently, dramatically different tax treatments result from the sale of a QOF, a QOZB, and a QOZBP. In fact, the selling of QOZBP appears to not yield any opportunity zone tax benefits. I strongly urge the IRS to synthesize these three scenarios and explicitly allow for the sale of QOZBPs to produce the desired OZ tax benefits to its QOF investors. Right now, an OZ investor may achieve gain exclusion after 10 years only by selling its QOF interest. Gain exclusion is achieved by an investor election to increase the tax basis of the QOF interest to its fair market value immediately before the sale or exchange. If the QOF is a partnership, the proposed regulations also provide that the QOF increase its basis in the partnership by the same amount. This can benefit a QOF partnership that owns assets that otherwise would generate ordinary income upon disposition. But a different result occurs if the QOF sells its interest in the QOZB. In that instance, the proposed regulations provide that if a QOF partnership or S corporation recognizes gain upon the disposition of its QOZB investment, the investor has held its interest in the QOF for at least 10 years, may elect to exclude from income some or all of its share of such gain attributed to the qualifying investment. The election only permits the QOF investor to exclude from income capital gain from the result of from the sale of the qualifying property. It does not specifically or explicitly apply to any ordinary income resulting from the qualifying sale, such as depreciation recapture. I appreciate that there's language in the proposed regulations to suggest that the 10-year asset sale applies to sale of property by a QZB, but I do not believe that it explicitly states so. Most QOFs are being structured with subsidiary entities owning the underlying property. For business reasons, not tax reasons, most buyers prefer to purchase property assets rather than interest in entities which own the property. With these observations in mind, I recommend that the IRS extend the exclusion provision to the entirety of the sales of property held by the QOFs, not just capital gain, as well as the sale of QZBP held by subsidiary entities in which the QOF invests, to the extent such gain is allocated to the QOF. And finally, the 10-year asset sale election is not one on which the investors may rely. This chills many potential investors who make investment decisions based on certainty of tax results. Looking at dispositions 10 years or more into the future, investors are extremely reluctant to commit dollars today without having a sense of what the rules will be applied when they may dispose of the investment. Investors are being told the no tax after 10 years rule may apply and may be available depending on what the IRS ultimately decides, with no particular commitment to publish a rule before their investment is made. The proposed regulations should be one in which the investor may rely. And fourth, triple net lease and active conduct of a trade or business. The proposed regulations confirm that the business of leasing real estate can qualify as an active trade or business for opportunities and purposes. Treasury then muddied the waters a bit by saying, however, merely entering into a triple net lease is not enough to be the active conduct of a trade or business. Opportunity zone investments are naturally aligned with the preservation and rehabilitation of communities' historically significant buildings, and many rehabilitations supported by historic tax credits utilize a master lease structure for credit delivery. We in the industry are struggling, as I think you've heard, in the uncertainty of the word mere, as Treasury used it and asked for guidance, through the use of examples and clarifying language. For example, you could use section 199A in the context of the qualified business income deduction. And to keep it short, I won't read that. And fifth topic is QOF investor relief if proposed financing or other conditions fail. There are many instances where an investor is admitted into a QOF, but the proceeds are not deployed into the project until certain conditions precedent are met. So the sponsor is comfortable or financially able to move forward on the OZ project. Satisfying these conditions may be subject to actions of third parties, force majeure, or the inability or ability of the developer to raise capital, equity, or receive the financing, in which case the sponsor of the QOF may choose to simply return the investor's money if they're not able to meet those conditions. Similar to reinvestment following dispositions, Treasury should allow taxpayers who have returned their gain investment dollars through no fault of their own a 180-day window to reinvest into another QOF. Lastly, I know others are going to speak on the concern with the netting rule applicable to 1231 gains and losses. We provided commentary on that as well and add my voice to reconsideration of that rule. And this concludes my remarks, and I appreciate the opportunity to share with you today and on what I think will encourage more investments in the zone. Thank you.
Thank you, Jill.
Jill, thank you. Very helpful points. Just on the -2C 10-year rule, would you envision a rule, as I asked the others, that would require a distribution of the proceeds in order to, for the QOF to avail itself of the 10-year limitation? In other words, if there's a sale outside, that's one thing, the investor has the cash, and the buyer of that can never get the benefit. So the question is, should you have parity between that and a situation where there's a sale inside, such that there would be a requirement to distribute the proceeds?
I think that is fair. And ultimately, from a business perspective, most investors that I've spoken with who are investing or considering investing significant amounts of capital do not understand that there's different treatments at the different tiers. And I think whatever gets us to the parity and synthesizing those three outcomes, I'm fine with. If that means a distribution, I would be fine with that.
Thank you.
All right.
Thank you.
Thank you.
Okay, our next speaker is Regina Stodecker from Howard and Howard. Good afternoon, and thanks for having us back. It's a pleasure to be here. One of you said this is a sacrifice of our time, and it's really not. It's really a refreshing experience to have the opportunity to talk with all of you and to listen to all of our colleagues, so thank you for listening. My name is Regina Stodecker. I'm a partner with Howard & Howard Attorneys. I as well was back here on Valentine's Day. And you are correct, there is a lot of energy in this space right now. We have established more than 20 opportunity funds and qualified opportunity zone investments. Frankly, we're at 25 as of June 30th, from everywhere from Las Vegas to Flint, Michigan. And what I'm bringing to you today are just a few of the challenges that we've noticed in setting up those structures. And many of them have been addressed today, so I'll try not to go into too deep on those comments specifically. But some of those challenges, is the way I would describe them, would be with the debt finance distributions that appear to be trapped in the April regulations associated with the modified disguised sale rules, the use of tangible property outside OZ locations as it relates to qualified opportunity zone businesses, the ability to recycle gains, and we've talked about this a tad as it relates to the multi-asset funds, but the ability to recycle gains that are triggered from the sale of underlying assets during the 10-year holding period continues to be what we view as a very, continues to be an area of great disparity in terms of investors that want to come into these funds as opposed to family offices that might be utilizing targeted investments to set up their own funds. So I think we're achieving different things by not allowing this recycling of gains within the 10-year hold period. Next would be the ability to utilize related party transactions. I haven't heard a comment on this because it seems to be pretty settled in. But in working with family offices and closely held businesses, one of the things that we have identified, and these were not in my prepared comments, so I'm happy to prepare something separate on this, is that related party sales where businesses have sold out or bought out family members or individuals within that are related purely because of sibling relationships or other type of relationships, those are precluded from doing investments into opportunity zones. In particular, what's interesting we're finding is that a lot of those same type of family offices are not able now to contribute those gains into high qualified community projects that would be unrelated to the transaction or the parties that created that related party gain. So I would compel you to give that some consideration. And I also have two additional comments. I'm not much of a policy person, but we have gotten comments back from many of our investors as it relates to the need for an intermediary to connect investors with projects and opportunity funds, essentially a matchmaker of sorts, to put projects and investors together. I know this is not the time and place, but I bring it up that we are often asked about this very concept. We attempt to do that. We can't be part of the promote. That's not what we do. But there is definitely a gap between the community and the investors in terms of how to find each other for qualified projects and investors looking for qualified projects. Lastly, we are working with some social impact investment funds who are specifically looking for advantages to invest in women-owned business and minority-owned businesses throughout Opportunity Zone locations. This is completely absent from the regulations. And again, I understand this is not your place, but I mentioned that in terms of if there could be a way to align other incentives for those types of entities within the Opportunity Zone legislation, or an ability to coach the communities on how to, again, make some of these minority businesses and or women-owned businesses with investors. I think aligning some of these incentives would make this legislation that much more powerful to people that need access to capital that don't currently have that. So the debt finance distribution comment, I'll address that quickly. I know Mr. Cullen and a couple others addressed that comment. I can speak to a specific example of an investor with a $48 million gain from 2018 that had a fund set up. We actually, as of the week before June 30th, abandoned that transaction for a large development in Minneapolis, specifically because of the new debt finance distribution language associated with the disguised sale modification. That created a big problem. We had banks that were willing to take part of that transaction, and so I was very interested in the conversation earlier in terms of looking at what the third-party market will do with an Opportunity Zone investment and their willingness to participate. And I think this is a perfect opportunity for us to enlist established banks that want to work with these developers and work with these investors to leverage that interest so that we can do distributions and then subsequent projects along with that, in that structure. So I think that's one that definitely needs further contemplation. And I did go into some more detail on my prepared comments on that. Second to that is the use and location of tangible property. I think Mr. Glickman made comments regarding use, and this is one of the areas as it relates to qualified Opportunity Zone businesses where we're finding it's the 70% use of tangible property is a bit prohibitive as it relates to businesses with mobile units, for example, mechanical contracting companies with vehicles that run across. The use of the tangible property is often used outside of the Opportunity Zone. So the 70% test of the tangible property creates a problem if we want to relocate or acquire a mechanical contracting company or even a technology company where they have portable laptops and things of that nature. So the ability to better utilize the testing for businesses would be very helpful if you really want to put headquarters and businesses in zones and still allow them to service their customers outside the zone. The last comment I would make, as I mentioned earlier, is the gain rollover within the 10-year holding period. I won't address that anymore other than, again, stating that I think that is what's preventing multi-asset funds from really getting off the ground, at least in terms of our investment base and of the funds that we've set up. The inability to reinvest and have gain transactions throughout the life of the 10-year holding period seems to be the primary issue that investors are staying back, and the lack of clarity around what would be that taxing event during the 10-year holding period. Lastly, I would, again, from a policy standpoint, just make a comment that we represent U.S. Hispanic Chamber of Commerce and executives from one of the only Latina SBICs in the country who serve to corporate sponsors such as the $1 Billion Roundtable. And it's there where we feel that there is a need for additional incentive to support investments with minority business and women-owned businesses. So with that, I'll reserve the rest of my time for other speakers.
Do you have a suggestion on the 70% use test, how we would clarify that?
Yeah, I think, I think there, it's really looking to the nature of the business really needs to be contemplated. And I keep going back to, when we talk to our clients, that look to the intent of the statute. And so it's really about the fact that if you go on an asset by asset basis test and do the testing, we run afoul of that testing. So I would think something, the percentages is challenging when you think of a mechanical contracting business with, let's just say, 200 or so service professionals. And that, I bring that one up just because it's one that we're working on right now, where they actually construct a facility in an opportunity zone, and they have all of these vehicles that are out running around, and service professionals, and they do some business on water repair, frankly, in Flint, Michigan, and some outside of that zone. They will fall outside of that 70% test, or fall beyond the 70% test as it relates to their tangible asset, yet the heart of the company is in the zone. And that's where the revenues are generated and all of these others. So I think that the linkage of 70% to tangible assets is what the issue is. So I don't know if it's the amount as much as it is looking to the underlying business and what is really driving the business and why it's located in that zone.
Gina, thank you for your comments. What if we could drill down on that example? I want to make sure we're not missing something with, as some refer to it as the disguised sale rule.
Mm-hmm.
It's really a rule that limits the amount that's deemed invested. Look at the disguised sales rules as a handy mechanism for making that determination. So if you could just tell us a little more about that fact pattern. So someone was going to invest $48 million?
Yeah, so we had a $48 million gain transaction in 2018 that was ready to be deployed by June 30th, 2019.
Just so let's call it an individual. Individual at $48 million of gain.
It was a partnership.
Okay, and that partnership was going to invest $48 million.
Into their own opportunity fund and
Okay.
invest into a new development in Minneapolis.
Okay, so it was going to just put $48 million down,
Yes.
and they had financing lined up.
Financing lined up with a single bank that has banked them for a number of
Right,
years.
and that bank was going to loan money to the co-op.
Exactly. And interestingly, looking to the underlying asset, which would be the new development.
Right, and was there an intended distribution of some of those proceeds?
That's where we got caught up, right? There was an intended distribution initially because they roll over and do additional investments.
So just to drill down.
It's really the 2-year period that's the issue.
Well, it's a disguised sale analysis, so if you get comfortable under the normal facts and circumstances rule of the disguised sale rules, then you get comfortable with this. But within a short period of time, were they going to distribute, say, half of that amount? So $48 million was invested. Were they going to borrow 24 and distribute it out immediately?
You know what's interesting about that is it wasn't, and that part of the plan was not defined. It was the normal business process would have been for there to be a distribution.
But out of normal
So-
operating, yeah, but they're under the disguised sale rules.
It could have been as much as half, yes. It could have been, in terms of if the question being, what would the plan have been? Because we abandoned it, it would have been as much as half of the 48 million to go back.
Yeah, just so I'm not missing an obvious point here. The source of the proceeds, say of 24 that would be distributed, the source was it the borrowing, was it operations, or a combination thereof?
It would have been the borrowing itself, yes. Yeah.
And that was prearranged from day one, more or
Yes,
less.
and what's interesting about that project specifically is that they have a track record of developing projects within 12 to 24, in fact, they do government contracts, and so they have defined projects that must be constructed within a period of time. So their project would have been completed before the end of this year, which is why the bank was very comfortable with that transaction.
So
So in our mind, it's all about there being economic substance to the underlying transaction that makes that. So our request is, the way it's currently written, it appears that there's a presumption of a disguised sale. And if we can get over there being a presumption of a disguised sale, I think we could have gotten them comfortable.
yeah, and just to be clear, we're not within the disguised sale rules. That's the mechanic for purposes of determining the amount of the qualifying investment. So 48 was going to go in, and maybe we can clarify this, and thank you for your comments. If 48 goes in, and let's say there's a prearranged deal with the bank to borrow 24 and immediately distribute that out, what the rules intended to deal with is to take the $48 million investment and say that if this would be a disguised sale based on the rules we put in the regs, then the 24 million distribution would actually reduce the amount of the qualifying investment. It would have no impact on the underlying fund. It would just say that effectively you put in 24 and the other 24 came from borrowing. So it would, again, it would just winnow down the amount of the investment. That's all it's intended to do.
Yeah, and what's unfortunate about that, the way it resulted for us is that instead of doing then the qualified opportunity fund, what they did is split it up between some 1031 and other transactions. But otherwise, they were looking to do, probably with that 48, probably 3 OZ developments, right? But instead, they didn't have the clarity, at least we weren't able to find the clarity that they needed to be able to pull it out without that being treated as, not eligible gain.
Okay, sorry. Just want to make sure that I'm not missing an opportunity. Your concern about the transaction between siblings and the sibling with the gain would like to invest in a qualified opportunity trust. That would appear to be facially inconsistent with the statute. Do we have anything that would let us satisfy what we need?
I don't see it there either, yeah. I
Um,
think it's an unfortunate result, and I understand the intention of it.
Yeah, I'm not saying that it's a perfect statute.
Yeah.
But, in terms of where we have elbow room to try to accommodate things that everybody would like to see, when the statute is this clear, that doesn't seem to be a constructive use of our brain power to try to figure a way around. The next, the idea of essentially the QOF being a little bit like an IRA in terms of free redeployment of assets into their most economically productive location. It's great economics, but unless there is in general, an explicit provision that realized gain does not get recognized, as there is with IRAs, as there is with a variety of other cases where Congress, they want it to be tax-free, they know how to say it. And there doesn't seem to be an opening here for that, however desirable you feel it would be, other than our saying to heck with the code. Is there an option that we could go with other than ignoring the realization?
Well, we've given that some thought as well in terms of the way that the step-up in basis works for the first 7 years. If there would be some corollary to even a recovery of basis on that second investment as opposed to a complete non-recognition of gain, that would be the only, that would be a mechanism that would allow, that could demonstrate there could be some recycling of the
So
original.
you're suggesting that the basis step-up would get sacrificed and that extra basis would sort of go in and shield some gain?
Yes.
And then finally, is there something that we have done that makes the ozone incentive less hospitable than it could otherwise be to these other goals? In other words, we tried to make it available to a variety of other kinds of taxpayers. Example, REITs and RICs. We can imagine a REIT being a plot. For the life of me, I can't see how a RIC could be, but we put that in there since it's a possibility. LIHTC is the absence of a back-end gain, which would be an unusual development for a real estate investment that has a minimum 30-year affordability commitment and maybe 45 in some locations. Is there anything that we have done that makes this regime less hospitable than it could be, or is it simply that we haven't manhandled the the natural consequences into something that will be more to your liking?
I think, again, I come back to the spirit of the legislation when we are looking at advising our clients. So I definitely am hearing your comments in the regulations about the spirit of legislation, and that's where I can find comfort with our clients in terms of steering them in the right direction. It's when we get into some of the particulars of
The tax lawyers, that's really.
I understand that. But I think it's when we get into the nuances and the traps that aren't obvious, that then 3 months go by trying to figure out what's the right answer, and now we've lost another year of an investment. So I think to the extent that we can embrace the spirit of legislation, and I'm not concerned about the table sitting here, we're all concerned about 5, 7, and 10 years from now, sitting in front of an IRS exam and having to explain the spirit of the intent was appropriate, and yet it's being interpreted differently. Right.
We will try to make it explicit when we are able to further the intent within the constraints that the code gives us. But the basic structure was given to us by the enactment, and it limits some things we might otherwise want to do.
Understood. Thank you.
Our next speaker is Maurice Daniel of Economic Inclusion Task Force.
Good afternoon. Thank you for the opportunity to speak to you today. My name is Maurice Daniel. I am here as a replacement for my colleague Moses Boyd, who was originally scheduled to give this presentation, but he had unforeseen travel complications. So I am, of course, substitute, but I am here nonetheless. Moses and I are a part of the Economic Inclusion Task Force, a stakeholder group whose aim is to see the proper implementation of the Opportunity Zone legislation. We're committed to assisting the rollout of this new investment tool that was, of course, created by the 2017 Tax Cut and Jobs Act. The Economic Task Force is composed of African-American men and women entrepreneurs formed following the White House meeting with Vice President Pence and U.S. Senator Tim Scott in the spring of 2017. The Economic Task Force advocates for advocating the economic growth in urban communities, and we have worked hard for the passage of the Opportunity Zone legislation. We believed then, as we believe now, strongly and resolutely, that the Opportunity Zone law, for the first time in decades, opens the door for much needed major capital investments in the urban, rural, and heavily African-American concentrated communities. In this regard, we are keenly interested in two vital goals: ensuring that the program operates to the benefit of the intended communities, and ensuring that there's significant diverse participation at every level of the program, including at the fund formation levels, ownership and management levels, and the business enterprises that will be the subject and the recipients of these capital investments. The specifics of the Treasury's regulations are crucial to achieving these outcomes. We would like to express our support for certain provisions that we believe are critical to these objectives, and we applaud Treasury for its tremendous work in implementing the regulations for advancing this law. We also believe that the department has achieved much needed progress in clarification manners that are providing more confidence to investors who are eager to engage in this new national investment. However, we do remain concerned about several issues. Regulations regarding the investment in operating businesses and substantial improvement tests, and the proposed 31-month requirement for determining active trade or businesses. Regulations regarding investments in operating businesses and the substantial improvement test application. This issue concerns the determination of substantial improvement tests either on an asset-by-asset basis or on an aggregate basis. The Department notice of proposed rulemaking indicates that this test will be applied on an asset-by-asset basis. However, given the nature of the target communities and what it's going to take to attract capital and realize successful investments in these communities, it is vital that the department allow for meeting the 30-month substantial improvement test on an aggregate basis as opposed to an asset-by-asset basis. For example, if a co-op determines to build a healthcare business park in a qualified opportunity zones, the assets will likely include adjoining commercial structures and parking lots. On an asset-by-asset basis, each of these assets would have to meet the tests individually. However, no rational investment strategy would operate this way. Only allowing for accounting on an aggregate basis do we believe that such investments are more likely. The proposed 31-month requirement for determining an active trade or business. The notice of proposed rulemaking suggests that the new investment and the new operating businesses and applies must be an active trade or business after 31 months of the deployment of capital. However, given that these investments are incurring in distressed and in many ways nascent markets for the purpose of major private capital investments, it is highly probable that it's going to take longer than 31 months before such an enterprise fully meets the test of an active trade or business. Consequently, we agree with the position of others who commented on this issue that the department strongly allow for the satisfaction of this requirement in the event clear evidence of advancement of the investment toward an active trade or business has been made and all the other safe harbor requirements for the deployment of capital have been met. I would like to raise one other point as relates to concerns that have been expressed to our group from local community groups, local organizations, and NGOs who play a strong role in attracting investments in these targeted areas. They've struggled with achieving clarity from the complex regulations in a plain language manner. They're concerned about finding what they need in the regulations, understanding what they find, and being able to interpret what they find to meet their needs. We at the Economic Inclusion Task Force would ask that the regulators consider these concerns in any future